Welcome to this Killik Explains finance video. This week, why equity market bears have been watching Japan recently. Okay, so let's go into it. A quick overview here. Basically, equity portfolios, if you take a broad equity portfolio, normally have a blend of what are called cyclical and defensive stocks. That's one of the ways you can break down a portfolio. And that's true whether you're talking about individual holdings or funds. Some funds are more defensive space, some are more cyclical space, and so on. Now, I'll come back to what those big words mean in just a moment. The balance depends on what is happening in the global economy, for reasons that will become apparent for those people who've forgotten what these words mean in just 1 second. And here's the point. Some observers have been watching that balance and they see a warning signal emerging over the last few months from Japan. So let's take a look at that. When Japanese defensives outperform, bracket cyclicals if you like, it can be a leading indicator of potential trouble ahead. To finish off his sentence there. And that's a global strategist at JP Morgan Asset Management. Not the only one who's picked up on this. So what's the problem and how wide could it spread? Well, no one knows the exact answer to that question. Let's take a look at some of the evidence, if you like, the pointers. Now, quick reminder first, cyclicals and defensives. What are we actually talking about here for those people who are wondering what on earth is the basis for some of these bear market observations? Quick reminder. So, cyclicals. These are firms whose fortunes tend to be driven by the economic cycle. All right? So, they are heavily dependent for their sales and profits on the confidence and discretionary spending patterns of firms and consumers. When consumers are feeling happy, these firms do well, their products fly off the shelves. When consumers are feeling less confident, drawing in the purse strings, these are some of the first products that get chopped, if you like. So these are firms that often pay little or no dividend. They're often sort of bracketed as growth stocks, if you like. They have high beta for the technicians out there. That just means that if you compare changes in their share prices to the broad market average, they're more volatile, all right, on the upside and the downside. And examples, there are plenty. Firms that sort of fit this description: technology, travel, entertainment, leisure, cars, durable goods. Look at it this way, places where consumers will tend to cut the budget when things turn south. Hang on to that thought. Defensives, the opposite in a way. These are firms whose fortunes are less tied to the economic cycle, in some cases almost immune to it. Now, how could that be? Well, their goods and services are needed in good and bad times. They often pay decent, consistent dividends as a result because their cash flows are more stable, more predictable than the firms on the left, if you like. But they offer relatively sluggish share price growth as a consequence. In other words, in a boom, all right, people don't generally consume more water, if you want to see it that way, or use more loo roll, all right, and equally in a bust, those are things you can't do without normally. So they're low beta and not very volatile in the sense that they don't swing around more than the wider market, if you like. Examples, lots of them out there: utilities, tobacco. Smokers tend to smoke, whether it's good times or bad times, if you like. Consumer staples, defence, and healthcare. Now, that's just a reminder about the difference between the two. So what's the observation that bears are making in Japan? Well, it's this chart, essentially. So here's what I call an interesting Japanese chart. Use of the word interesting depends on your perspective, I suppose. But here it is. It's the Japanese cyclicals defensives ratio drawn from Van der Bloomberg data. And without bashing the underlying bits and pieces, the mechanics of the chart too much, what this is basically showing is this. People in the Japanese markets, people buying Japanese stocks, have been happy, that line there, to move on average into cyclicals out of defensives. The balance of buying has been cyclicals rather than defensives. Those stocks that are dependent on the economic cycle, not kind of immune to it. But, and here's the point, if you look at what's been happening just relatively recently, okay, that has changed. This line suggests that suddenly there's been a bit of a move back into the more stable defensive stocks and out of cyclicals. That's the essential message that we're trying to get across here. Okay, so an obvious question to ask would be, well, if that's happening in Japan, is it happening elsewhere? And then what do we conclude from this? Well, so far, optimists would say this is just Japan. All right, and they've got a point. If you were to look around other charts at the US and Europe, to pick but two, you would see similar ideas, cyclicals defensive ratio. You can see, broadly speaking, continuing its sort of broadly upward trend over the last few years. So people who don't think this Japanese signal means anything would say, well, if you look at big other parts of the global economy, we're not seeing the same movement out of cyclicals into defensives. So what are we to read into this? The so what, if you like. Well, in a nutshell, the bears will say Japan is seeing signs of a move into defensive stocks. That line I showed you. This suggests mounting nervousness on the part of investors because investors are sort of starting to abandon the economic cycle-driven stocks in favour of the more stable, steady cash flow generators. Japan is highly geared to the US and Chinese economy, and, probably most important, when Japan last showed signs like this on a similar chart, it was back in 2007, and we all know what happened next. Pressures of the financial crisis and a similar move in other parts of the world. But, and here's the but, people who don't buy this would say actually Japan is uniquely sensitive, perhaps in a way that other economies are not, to the short-term outlook of the US. Short-term being the point there. We saw a similar move in this ratio back in 2014 and it signalled precisely nothing. In other words, share prices carried on climbing, cyclicals didn't suffer elsewhere just because there was a short-term blip in Japan. We haven't seen any support really for this move in other economies, and therefore, as an investor, perhaps this is a watch and wait. In other words, keep your eye on it. It sometimes has presaged trouble in the past, but at the moment, there's no need to sound the alarm just yet. Okay, so lots of ground covered there, and a chart that I haven't said much about. If you want to email me to find out more about that chart, or anything more about cyclicals, defensives, and so on, if I lost you slightly there, it's editor@killik.com. And to see related videos on topics close to this one, killik.com/learn.